If you invested just $10 a week, what would actually happen over time? Not in a hype way, not with unrealistic stories, just the real mechanics explained calmly. Because $10 a week feels small, it feels like it couldn't possibly matter. But the point of small investing isn't the size of the first deposit, it's the system you build and the amount of time you give it to work. In this video, I'll show you exactly what $10 a week can do, what it can't do, and how to set it up so it becomes a quiet habit you don't have to think about. Quick framing before we start. This isn't financial advice. It's a simple, educational breakdown of how investing tends to work in real life, explained clearly and calmly. Nothing here is about quick wins, and I'm not going to promise returns because no one can. What we can do is understand the system, how regular contributions build momentum, how time changes everything, and how to avoid the common ways people accidentally sabotage themselves. And if you're new, that's the best place to start. Understanding first, action second. Here's how we'll do this, and I'll keep it beginner-friendly the whole way through. Part 1 is the core concept. What investing $10 a week is really doing and why the smallness is actually the point. Part 2 is the math example. We'll walk through the numbers slowly, starting with the simplest version where nothing grows, then we'll add a gentle growth effect just to see how the shape changes over time. Not as a prediction, just as a model. Part 3 is the setup, how you'd actually put this into place in a way that's calm, boring, and sustainable. What to do first, what to avoid, and how to stay consistent without watching the market like it's a scoreboard. And in a moment, I'll show you the first number that makes this click. Because once you see it, the whole idea becomes less abstract. Let's start with something simple. $10 a week is not a get-rich number. That's not the job. The job of $10 a week is to turn you into someone who invests. Most people think investing starts with a big lump sum, like you need thousands sitting there waiting. But that's not how real investing usually begins for normal people. Real investing begins as a habit. It begins with consistency, and it begins with learning how it feels to put money into something you won't touch for a long time. $10 a week is small enough that you can usually fit it into a normal life. It's the price of a few coffees, a meal you didn't order, a couple of subscriptions you forgot you had. The point isn't to shame anyone's spending. The point is to choose one small amount and make it automatic. Why automatic? Because consistency is easier than motivation. Motivation comes and goes. Systems stay. Now, what happens when you invest regularly? There are two forces you're combining. The first force is the obvious one. You are putting money in. If you invest $10 a week, you are adding $10 a week. That's straightforward. The second force is the one people talk about, but often don't really feel until years later. The money you've already put in can start to produce returns on top of itself. People call this compounding. It's a boring word for a simple idea. Growth can stack. But I want to be careful here because the internet often talks about compounding like it's magic. It isn't. It's math plus time plus patience. Here's an analogy that helps. Imagine you're pushing a heavy wheel. At first, nothing feels like it's happening. You push and it barely moves. But you keep pushing, and eventually the wheel starts rolling. And once it's rolling, each push does more because you're adding to momentum instead of starting from zero every time. That's what small investing is doing. It's building momentum. And this is where beginners often get stuck. In the early months, the numbers look unimpressive. You invest for a whole year and it still doesn't feel like much. That's normal. Early on, your contributions are the main engine. Later, if the investments grow over time, the growth can start to matter more. In a moment, I'll show you the exact year one number because it's the quickest way to make this real. Before that, there are a few basics you need so you don't get confused later. First, investing is not the same as saving. Saving is usually money you might need soon. It's there for stability. It's there for emergencies. It's there so you don't panic. Investing is money you are deliberately willing to leave alone for a long time. And because you're leaving it alone, you accept that it can go up and down. The price moving around is normal. It's not a sign you did something wrong. Second, the goal of investing $10 a week is not to find the perfect investment. Beginners tend to think the whole game is picking the best thing. the perfect stock, the perfect moment, the perfect strategy. That thinking usually leads to stress, overtrading, or giving up. A calmer way to think is this. You want a simple, diversified approach that you can stick with. Diversified just means you're not betting everything on one company or one idea. Instead, you spread your money across many things, so one bad event doesn't decide your future. A common, beginner-friendly way people do this is through broad index funds. That's just a fund that owns lots of companies, often across a whole market. You're not trying to guess winners, you're buying a slice of the whole thing. Third, when you invest small amounts regularly, you're naturally doing something called dollar-cost averaging. Don't worry about the jargon. Here's what it means. Sometimes the market is up, sometimes it's down. If you invest the same amount every week, you'll buy a bit more when prices are lower and a bit less when prices are higher. Over time, you're smoothing out the average price you paid. You're not relying on being a perfect timer. That's one of the reasons $10 a week can be calmer than I'm going to invest a big amount today. Small and regular reduces the pressure to get the timing right. Fourth, the biggest enemy of small investing isn't returns. It's behavior. People sabotage themselves by stopping and starting, by panicking when things drop, by checking their balance constantly, by treating investing like a short-term game. If you're investing $10 a week, the correct emotional posture is almost boring. You set it up, you keep going, you only adjust when your life changes, and you measure progress in years, not days. Now the number I promised, $10 a week, is $520 a year. That's it. That's the first anchor. And that's already useful because it turns a small weekly decision into an annual habit. In 1 year, you didn't try investing. You built a base. In 2 years, you built a bigger base. Over time, you built a meaningful pot. In a moment, we'll build out the full timeline and see what the numbers look like over 5 years, 10 years, and 20 years. Because that's where the psychology changes. When you see the long view, the weekly amount feels different. But before we do the math, one more calm truth. Investing is not a straight line. If you invest into something linked to markets, your balance will sometimes be below what you put in. That can happen even when you're doing everything right. That's the cost of participation. The reward, historically, has tended to come from staying invested for long periods, not from cleverness. And that's why the real value of $10 a week is that it trains you to stay consistent through normal noise. Now let's do the math slowly, and we'll do it in a way that doesn't require you to believe any promises. We're going to build this in 2 layers. Layer 1 is pure contributions. No growth, no interest, nothing fancy, just you putting money in. Layer 2 is the growth effect model. Not as a forecast, not as a guarantee, just to show how time can change the shape if your investments do grow over the long run. And before I show you the setup, there's one mistake that ruins this for most people. It's not picking the wrong fund. It's quitting too early because the early numbers look small. So as we do this, notice what happens to the numbers later on. Okay. Layer 1, contributions only. You invest $10 per week. There are 52 weeks in a year. So in 1 year, you invest about $520. In 5 years, you invest $520 times 5. That's $2,600. In 10 years, it's 520 times 10. That's $50,200. In 20 years, it's $520 times 20. That's $10,400. That's already worth pausing on. Because if you told most people, would you like to have $10,000 extra in 20 years, created by a small weekly habit, they'd say yes. But when you phrase it as $10 a week, it feels too small to bother. So even without any growth, the habit builds something real. Now layer 2, the growth effect. To be clear, I'm not going to use this to promise you returns. Instead, I'll show 3 illustrative paths. Think of them like 3 different weather patterns over a long journey. Real life will be messy. The point is the shape, not the exact ending. Path 1 is the same as before. No growth at all. Your pot after 20 years is the $10,400 you put in. Path 2 is slow growth. In this model, your money grows enough over time that your final pot is roughly around 1 and a bit times what you contributed. Path 3 is stronger growth. In this model, your money grows enough over time that your final pot is meaningfully higher than what you contributed. Again, these are not predictions. They're just showing how compounding changes the outcome when you give it time. After 5 years, you've contributed $2,600. In the no-growth path, you have $2,600. In the slow growth path, imagine you end up with something like $2,900 to $3,200. In the stronger growth path, imagine something like $3,300 to $3,800. Notice something important. Even with growth, after only 5 years, the difference isn't gigantic. It's helpful, but it won't feel like a movie scene. And that's why people quit. They expect fireworks early. Now, after 10 years, you've contributed $5,200. No growth path, $5,200. Slow growth path, imagine something like $6,300 to $7,200. Stronger growth path, imagine something like $5,500 to $9,000. Now the gap starts to matter. Not because you did something clever, but because time gave the growth a chance to stack. Now, after 20 years, you've contributed $10,400. No growth path, $10,400. Slow growth path, imagine something like $14,000 to $18,000. Stronger growth path, imagine something like $20,000 to $28,000. And here's the key. The longer the timeline, the more the growth effect can matter. That's the entire reason people talk about starting early. Not because early makes you special, because early gives time. If you're watching this in your 20s, you have an unfair advantage. Years. That's it. Now, let's make this feel even more real by translating it into your life. $10 a week is $520 a year. That's about $43 a month. So another way to think about it is, could you automate about $43 a month into long-term investing? If yes, then you're not trying to win a financial game in 1 year. You're building an engine. Also, notice what we didn't do. We didn't chase the best stock. We didn't assume perfect timing. We didn't assume you never had a bad year. This isn't built on perfection. It's built on consistency. Now, one more layer that beginners often miss. Fees. Fees are just the cost of running an investment product or platform. They can look small, but over decades, they can quietly reduce what you keep. You don't need to become obsessive about fees. You just need to be aware that simple and low cost is usually a good direction for beginners. The reason is not because it guarantees outcomes. The reason is because lower friction means more of your money stays in your system, year after year. In a moment, I'll show you the calm setup, step by step. But before we do, there's one behavior rule that makes the biggest difference. Don't treat your investing balance like a mood indicator. If you invest weekly, your balance will move. Sometimes it'll be up, sometimes down. The habit is the point. Your goal is to keep the system running while your life happens in the foreground. And that brings us to the practical question. How do you actually do this in a way that's easy to maintain? Let's turn this into a simple setup you could actually live with. The goal is not to build the perfect investing plan. The goal is to build a plan you will still be doing in 5 years without needing constant willpower. Step 1 is not investing. Step 1 is stability. Before you commit money to long-term investing, you want a small buffer for short-term life. An emergency fund is just a cash cushion, so you don't get forced to sell investments at a bad time because your car broke, or you had a surprise bill, or your hours got cut. You don't need a massive emergency fund before you start investing, but you do need some breathing room. If you invest $10 a week, but then keep pulling it back out every time life happens, you're not investing. You're just moving money around. So the calm approach is build a modest cash buffer while you start the habit, or build the buffer first, then start. Either is fine. The principle is don't make investing your emergency fund. Step 2 is making it automatic. Pick a day of the week. Pick the amount, $10, and set it to leave your account automatically. Automatic investing is powerful because it removes decision-making. You don't wake up and ask, should I invest today? It just happens. And because it's small, it doesn't feel like a dramatic event. Step 3 is choosing a simple container. A container is just the account type you invest through. In the US, many beginners use tax-advantaged accounts designed for long-term investing. Rules and limits change, so the safest beginner move is choose a reputable platform, understand the basic account type, and check current rules when you open it. Step 4 is choosing a simple investment. This is where people overcomplicate. You're investing $10 a week. The point is broad exposure and consistency. A diversified fund that spreads your money across many companies is a common beginner starting point. Again, not because it's perfect, because it's simple and resilient. If you don't know what to choose, a good rule is avoid anything you can't explain in one sentence. If you can't calmly say, "This fund owns a broad spread of companies, and I'm holding it long term," it's probably too complex for the job we're doing here. Step 5 is deciding what success means for you. This is important because it stops you from panicking. If your definition of success is "my balance must go up every month," you're setting yourself up for stress. A better definition for the first year is behavioral. I invested $10 every week for 12 months. That's a real win. That means you built the habit. In a moment, I'll summarize the whole system in a simple way you can remember, but there are 2 more rules that protect beginners. Rule 1. Don't constantly adjust. Beginners often react to news. They see a headline and they want to change something. But investing for the long term is not a daily decision. If your plan is diversified and consistent, you don't need to respond to every headline. Rule 2. Don't measure this weekly. If you invest weekly, the action is weekly. But the measurement should be slower. Monthly or quarterly is plenty. For a long-term plan, even once or twice a year can be enough. Your weekly behavior is what matters, not your weekly balance. Now, what if you can't do $10 every week? The idea still works. It's the habit that matters. If you can do $5, do $5. If you can do $10 most weeks and occasionally miss one, that's still fine. This is about building a system that survives real life. And what if you can do more than $10? That's great, but the same principle applies. Increase it only when it feels sustainable. You don't want a plan that collapses the first time your month gets expensive. The calm setup is start small, automate it, keep it simple, and let time do the heavy lifting. In a moment, we'll close this with a summary and the next step, because the most useful thing is leaving this video with one clear mental model you can carry with you. Let's pull it together. If you invest $10 a week, the first thing that happens is not magic. The first thing that happens is you build a system. You turn "I should start investing" into "I invest every week." And that shift matters more than people realize. The simplest math is this: $10 a week is about $520 a year. Over time, that adds up even if nothing grows. And if your investments do grow over the long run, the shape can change. Not because you found a trick, but because time allows growth to stack on top of consistency. The calm way to approach this is keep some short-term stability in cash so investing doesn't become an emergency fund. Automate the weekly amount so you don't rely on motivation. Use a simple, diversified approach you understand. Measure progress slowly and judge success by consistency, not by short-term movement. You don't need to rush this. Understanding the system is more important than trying to time anything. The whole point of $10 a week is that it's small enough to do without fear and consistent enough to matter over time. And if you want the next step, the next video is about the most common investing mistake beginners make. Not a dramatic one, a quiet one. The kind that costs people years without them noticing. Watching that next will help you protect the habit you're building here, so your $10 a week actually stays a long-term system.